welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index for our chart. All charts to be presented are to be of the same time frame, unless otherwise stated. Today, we will be mixing practically fundamentals with technicals. To make a start with it, let's place the labels on the resistance support lines. Starting with the R3 at 108.30. And that should be in red. Okay. The R2 at 107. The R1 at 105.50. Let's verify that. Yep, that's clear. The S1 at 104.40. Definitely that should be in the greens. The S2 at 103. And finally, the S3 at 101.90. That should sum it up. Before we move on, allow me to zoom out a little bit. Okay, that's pretty interesting. And let's start the technical analysis part for the US dollar by drilling out from the 4-hour chart into the weekly chart, 1 week chart if you prefer. And that tends to be more clear given that you can see that there was a nice upward trend line which seems about to be interrupted. Definitely the bullish trend does not seem to be altered, but nevertheless, it's still interesting how greenback bulls seem to be hesitating this week. And let's delete the trend lines and replace them a little bit. Drilling into the 1-day chart. That's even more clear. Note that we had the correction lower and another peak, a new higher peak. Very, very interesting. Note how the resistance lines are finding exactly meeting the levels and the price action. Second time here, 1, 2, 3. Okay, and let's drill to the 4-hour chart. Even more detail. Let's reposition the labels. It's important that you have a clear physical view, a very quick and easy understanding on where the trading instrument is heading to, whether it's going up, whether it's going down, or moving in a sideways fashion. And should it rise or should it fall, how far it can go. And that's being served primarily by the trend line, which highlights the direction, but also the resistance support lines, which tend to show us how high it can go, how low. For the time being, we tend to maintain a bias for the sideways motion to continue in the 4-hour chart, given also that the RSI indicator is running along the reading of 50. On the other hand, though, let's not forget the bullish tendencies, which may occur given the upward trend line remains intact. So, over the next 24 hours, I would expect the dollar to remain rather sideways. It's interesting how the US dollar remained relatively unchanged also by the release of the US CPI rates for August yesterday. And let's have a look at what the market reaction was at the time of the release for the US dollar index. Drilling now to the 1-minute chart. Widening it. And going back. Where it is. There was a slight upward movement of around 30 pips. Okay, 30 ticks, sorry. So that was interesting. But see how the reaction was only instant. So it lasted only for a couple of minutes. And quickly the index rolled back down again, losing any gains it had made and moved to even lower levels. Back to the 4-hour chart. So we tend to maintain a bias for a sideways motion to continue on a technical level, as we have mentioned. On the other hand, we have to highlight that today we're getting the PPI rates and the retail sales growth rate for the US in August. Now, the PPI rates are expected to accelerate, which would be confirming practically the inflationary pressures within the US economy, that they remain rather stubborn. The retail sales growth rate is expected to slow down, which may imply a slight retreat of the demand side for the US economy. But overall, we may see the US dollar remaining in a rather sideways motion. There's also the initial jobless claims figure, but that's not so much the focus of traders. Right now, we're talking about inflation mostly. Overall, we expect that the stubborn inflationary pressures may sharpen the Fed's rhetoric in its interest rate decision next week. And I would highlight the possibility of the Fed being influenced not in next week's decision as such, but we may see a greater impact in the November decision. For the time being, the market expects the Fed to remain on hold. It's characteristic that a number of analysts have highlighted that the Fed may be done with hiking rates. On the other hand, though, I would be noting that inflationary pressures are still there. They're clearly above the Fed's target. And the US employment market, despite taking a hit, it's quite tight still, given that we have an unemployment rate at 3.8%. That's not bad. It's actually pretty good. And it may allow for some more leeway for the Fed should it opt for a more hawkish approach and actually hike rates if it wants to. Once again, for the time being, we expect that the Fed's going to remain on hold. However, I'm not so certain about that. It's something which deserves more analysis. Because we have to maintain also in view that most probably the Fed's going to be prolonging the period at which it will be maintaining higher rates. So practically the financial environment for the US economy is going to remain at rather restrictive levels for the monetary policy wise. And the cumulative effect of a prolonged period of restrictive levels of interest rates could more or less play the desired role and actually curb inflationary pressures. On a technical level, should the bulls take over, we may see the price action of the US dollar index rising above the hour 105.50. While a bearish outlook, for bearish outlook, I would require the price action to break the S1 104.40, but also to break the upward trend line we have highlighted and start actively aiming for the 103 S2. Let's have a look at Euro USD. Okay, let's start by zooming a little bit out. Let's place the labels here. Starting with the R3 at 1.10 in red. There we go. Second resistance line at 1.0865. Let's verify that. Yep. Let's lock it in. R1, we're placing it at 1.0770. Once again, let's verify it. Yep. First support line at 1.0670. Second support line at 1.058. And third support line at 1.0460. Now, members of the research team have highlighted practically an element which we do not have depicted on a chart, and that would be an upward trend line. Let me show you what they meant. It was this. In my opinion, I understand that there are high highs, high lows, yes, but it's still not as convincing for a bullish outlook. For the time being, on a technical level, I would maintain a bias for a sideways motion. So allow me to delete this. And that's based that there has been no decisive upward movement on behalf of the pair. While on the flip side, we note that there are RSI indicators running along the reading of 50, which tends to imply a rather indecisive market. Should the bulls take over, or if you prefer for bullish outlook, I would require the pair to break clearly the R1 1.0770 and start aiming for the R2 1.0865. On the other hand, should the bears be in charge, we may see the pair dropping, breaking the S1 1.0670. That would be a prerequisite for bearish outlook, and start aiming for the 1.0580. Now, on the fundamental level, because for Euro USD, the next big test is today. It's the ECB's interest rate decision. There's wide uncertainty on whether the bank's going to be hiking rates or not. Currently, Euro OIS implied probability of around 60%, actually 64, for the bank to proceed with a 25 basis points rate hike. Yet there have been a number of analysts which highlight that Germany has been experiencing a contraction of economic activity and is about to enter a recession, and that may soften more or less ECB's approach and in turn allow for rates to remain unchanged. So it's a decision which is being played out between hiking and remaining on hold here. Should the bank decide to hike rates, I would expect that a part of the market will be taken by surprise. And that could provide some support, substantial support for the euro side of the pair, pushing euro USD higher than the R1 1.0770 and allow it to start aiming for the 1.0865. There is also the possibility that the bank remains on hold, in which case we may see practically the euro weakening somewhat. And in that case, we may see Euro USD dropping, breaking the S1 1.0670 and start aiming for the S2 1.0580. Now, there are two more elements of the interest rate decision which are worth mentioning here. The first is the tone of the accompanying statement. So it's not the interest rate level as such, but also what the intentions of the bank actually are. Now, should the bank actually proceed with a rate hike, yet highlight or imply that it has reached its terminal rate and is done with hiking, we may see, despite the hike, the euro weakening and euro USD dropping. On the other hand, should the bank remain on hold but highlight that this is a mere pause and more rate hikes are to come, or another rate hike is quite possible, that could still, despite the bank remaining on hold, provide some support for the euro side of the pair and allow euro USD to rise above the R1 and start aiming for the R2. Now, the differentials here may play a key role to the size of the market reaction, so we should be keeping a close eye. And there is another issue, the third element which we have mentioned. That would be ECB President Christine Lagarde's press conference later on. Now, the ECB President has proven a number of times that she's more than capable to actually change the market sentiment after the decision. So it's a big issue what Christine Lagarde will be actually saying. A best guess would be that Ms. Lagarde is going to be trying to ease market reactions. And in that case, we may see any possible gains or losses more or less allowing for Euro USD to restabilize. It's going to be a very interesting 3 hours in the afternoon today, in the European afternoon. And I would be advising substantial caution for Euro traders should they be in the market at the time of the release. Use your stop losses and be on your guard. Okay, let's have a look at GBP USD, showing a similar picture. Let's place the labels. Starting with the S3 at 1.22. Moving now to the S2, which is to be placed at 1.2310. To the S1 at 1.2445. R1 at 1.2535. R2 at 1.2630. Allow me to verify that. Yep. That's it. And last but not least, the R3 at 1.2795. Okay, let's talk fundamentals here. BOE's interest rate decision is next week. It's going to be an interesting week next week. We have more than 5 interest rate decisions, if I'm correct. We have from Switzerland SMB, from Turkey CBT, we have Norges Bank from Norway, we have the US Fed, we have UK's BOE. Now, the latest data, I would say, tend to be conflicting for the BOE in the following sense. On the one hand, we have a high average earnings growth rate, which practically tends to imply that the UK employment market, despite taking a hit on the employment change figure, a substantial hit, is expected to continue to feed inflationary pressures in the UK economy. So that's practically an inclination, or if you prefer, a call for the bank to continue hiking rates. On the other hand, we had also the GDP rates on a month-to-month level yesterday, which showed that the UK economy contracted, and that would more or less be calling on BOE to stop hiking or ease its allocations at any level, to allow practically the UK economy to start growing once again. So, in my opinion, I think BOE is going to be focusing on inflation mostly, and that may allow it to hike rates. Yet at the same time, I wouldn't be surprised to see the bank actually issuing a warning about the economic outlook of the UK. On a technical level, we tend to maintain our bias for the sideways motion to continue between the R1 1.2535 and the S1 1.2445. The RSI indicator has dropped slightly below the reading of 50. So we may be seeing slowly but steadily a bearish sentiment building up, but for the time being, nothing conclusive or nothing convincing. For a bearish outlook, I would require the price action to break the S1 1.2445, exactly highlighting this escape from the current sideways motion, given that the S1 currently also plays the role of the low boundary of the current sideways motion. So for bearish outlook, I would require the GBP USD to break the S1 and start aiming for the S2. On the other hand, should the bulls take over, we may see the cable rising, breaking the R1 1.2535, and start aiming for the next level, which would be the 1.2630. Okay, let's have a look at USDJPY. Also, which tends to maintain a rather solid sideways motion. Let's place the labels, starting with the R3 at 151.9. Moving now to the R2 at 149.40. Moving now to the R1 at 147.80. S1, the first support line, being placed at 146.10. Being green. S2 at 143.70. And finally the S3 at 141.60. That's it. There we go. So overall, we see that the sideways motion is being maintained, and that's being highlighted practically by the flattening of the moving averages, the narrowing of the Bollinger Bands, the fact that the moving averages maintain a steady distance between themselves, implying that the 50 moving average was not able to pick up any movement or any change of direction, which would be altering its direction. On the other hand, though, I would be noting also the RSI indicator, which seems to be lifting from the reading of 50s, a little bit steadily. It's currently at 55. Once again, nothing convincing, but it's an indication. Our outlook remains for the sideways motion to continue between the 147.80, a level which was tested once, twice, very nicely. While to the downside, we highlight the 146.10, which was tested once here. Second time here, this was the moment, the day where practically Weda made this comment that he would be optimistic that the bank would be able, BOJ, would be able to escape the negative rates. And that tended to provide some substantial support for JPY. It was almost a verbal intervention on behalf of BOJ here. But that's fading away, and JPY weakened a little bit, landed the gains made, and seems to be stabilizing nicely between the R1 and the S1. As we mentioned, for a bullish outlook, we would require the pair to break the 147.80 and start aiming for the 149.10, nothing less. On the flip side, should the bears take over, we may see USDJPY dropping, breaking the S1 146.10, and start aiming for the 143.70. However, the current inactivity of the pair does not seem to imply such a scenario as probable. On the fundamental side, besides the USD fundamentals, and on the JPY side of the pair, I would be highlighting two issues here. The first would be BOJ's monetary policy settings. Should there be any signals from BOJ policymakers that the bank may be keeping its ultra loose monetary policy settings in place for a prolonged period of time, that could weaken JPY and allow USD/JPY to rise. On the other hand, should there be any turbulence in the market, which would be able to create some safe haven inflows for JPY, that could strengthen the JPY part of the pair and force USD/JPY to drop below the S146.10 and start aiming for the S243.70. Once again, for the time being, we tend to maintain a bias for the sideways motion to continue. Let's have a look at the Aussie. Let's zoom out a little bit here. That's better. And let's readjust the chart. Bring the label forward. Let's place the labels now on the resistance support lines, starting with the S3 at 0.6170. Let's place now also the S2 at 0.6285. And the S3 at 0.6380. Sorry, S1. R1 to be placed at 0.6510. R2 at 0.6610. And the R3 at 0.6730. I think that's pretty clear that the pair tends to remain in a sideways motion. There was some support at the release of Australia's employment data for August, as they were better than expected. Actually, the unemployment rate remained unchanged, but the employment change figure and the participation rate got a boost, and they were better than expected. And that, I think, tended to provide some support for the Aussie, which was relented later on. Allow me to show you the market reaction at the time of the release. Drilling now to the minute chart, widening it. Here it is. It wasn't much, it was instant. And we're talking about 14 peeps. Nothing much, but it was very characteristic at the moment of the release. And traders' attention, Aussie traders' attention, is now slowly but steadily turning towards China. We are getting the urban investment growth rate, we're getting the industrial output growth rate, and the retail sales growth rate. Now, all three of them definitely primarily affect the yuan, but they may also have an impact on the Aussie. There have been widespread worries about the Chinese economic outlook. A possible acceleration of these rates would allow for more optimism to emerge and for Aussie traders to start hoping for wider or more exports of raw materials from Australia towards China, which would possibly have a positive effect on those as well. In the bigger picture here, note that the manufacturing sector of China has been experiencing some struggling. It's between exactly contraction and expansion. Around the reading of 50, we had PMI figures which came on both sides. I would be noting that a possible acceleration of the industrial output growth rate would allow for more optimism here. The urban investment growth rate would be a little bit more indicative regarding the construction sector of China, which is also heavily troubled. While the retail sales growth rate is going to show us whether the Chinese economy tends to retain a strong internal demand side, which may provide additional support for, okay, it's mainly exporting manufacturing sector, but also for the internal demand side. Now, should the readings be better than expected, we may see the Aussie getting some support here. Overall, though, on a technical level, we tend to maintain a bias for the sideways motion to continue between the S1 and the R1. For bullish outlook, I would require the pair to rise, break the upper boundary of its current sideways motion. That would be the R1 0.6510 and start aiming for the R2 0.6610. On the other hand, should the bears take over, we would expect the price action to drop below the S1 0.6380 and start aiming for the S2 0.6285. The RSI indicator rose a little bit, touched the reading of 60, but now is correcting lower and is currently aiming for the reading of 50, implying more or less that the bullish sentiment seems to be fading away among market participants, and that would allow practically for the sideways motion to be maintained here. On the other hand, I would be highlighting also that the Aussie remains a commodity currency mainly, or is regarded as such. So the market sentiment plays a substantial role regarding its direction. Should the market sentiment start turning more cautious, that may start weakening the Aussie, as practically that would imply that the prospects for the Australian economy start to narrow. On the flip side, should there be a more optimistic outlook about the global economy, we may see the Aussie getting some support, as that would more or less imply more exports of Australian raw materials, not only in China, worldwide. But definitely China remains the main trading partner for Australia right now. Exactly this viewing of the Aussie as a commodity currency tends also to highlight a more riskier nature. And I think that should be about it. Last thing just to keep in mind, let's not forget that in today's American session, we have the IPO of ARMS. Now, ARMS is a British chip maker. It's a company which, due to the sensitivity of the nature of its business, but also due to its size, it's well known, it's going to be attracting substantial interest among traders. Mind you that the IPO seems to have been overbooked and closed orders one day early. The price is to be at around, we expected around $51 per share. However, at the time of the release, we expect that there will be substantial volatility around the share's price. So it's something which would be interesting and you could have a look at. From all of us here at IronFX, best wishes for solid trading.
Okay, great. So let's go ahead and just get right into it. So as I mentioned earlier, today's webinar will be on trend lines, channels, and liquidity traps. So this is the second part of our two-part series on support and resistance. But if you missed last week's webinar on support and resistance, just the first part, no worry, because we'll do a brief recap before we get into the new stuff. Okay. Excuse me. Okay, let's go ahead and get started. So I'm Melanie. I'll be your speaker for today. I'm an investment analyst from Everest Fortune Group, who are finalists for Best FX Research and Equity Research in the years 2019, 2020, and 2021. Oh yes, before we get started, just a disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead an educational material only. This material is just the personal opinion of the authors, and the client's investment objective and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, so here's our agenda for today. We're going to do a quick recap for our first part of this series. We're just going to be briefly going through pullbacks and overlap support and resistance, just so you are on track with whatever we're going through for today's webinar. After that, we'll get right into this week's session. So we're going to be talking about trend lines and what is considered a valid trend line and trend channel. And then we're going to be talking a little bit about liquidity traps and what exactly they are. Okay, just to double check, everyone can hear me, right? Because in my it says that my volume is a little bit low. So I'm just checking to make sure everyone can hear me clearly. Okay. If at any point throughout the webinar you can't hear me, just let me know in the chat. Okay, so let's get started with the recap from last week. So we're going to be talking about pullbacks first. So a pullback support is a strong level of support because it breaks out from a previous resistance level and price is now dropping back to visit it again. So a pro tip, when a pullback support lines up with a Fibonacci level, it is very powerful. A pullback resistance works well when it breaks a significant swing low and then starts pulling back to it. It's even better if there are multiple Fibonacci levels that line up with it. So we'll go through a few more examples in the coming slides, but you can see here in this GIF that we've included, we have a swing low here, swing low support, and this swing low support lines up nicely with this 38.2% Fibonacci retracement and also the 61.8 Fibonacci retracement. And so what happens is that we are expecting price to pull back or retrace back to the same level here. But once it retraces, we can also expect it to reverse off of it. Why? Because there is a large area of Fibonacci confluence because of the two levels that line up nicely. Okay, so let's take a look at another example. So here we have this red area. Price has tested this level 3 times with multiple swing highs in line with one another at the resistance level. So once price breaks the red area, it becomes a pullback support level, and we expect price to pull back or retrace this level, as you can see from the dotted lines here. Okay. So it's basically when price breaks out of this resistance or support, then it becomes a pullback support or resistance. Okay, here's another example. So here we have a multiple swing low support level. You can see these 3 arrows. So it's more of an area than specifically one level. But here we have a swing low support, and price actually broke out of this level over here. And once it breaks out of the level, it then becomes, instead of a support, it becomes a resistance. Why resistance? Because we're expecting price to pull back or retrace back to this level and reverse off of it. So obviously, once it reverses off of it, it becomes a resistance level. So that's what we are expecting it to do. Okay, so here's another example from an actual chart. So we have a swing low here, swing low support, and then price reversed off this level or bounced off this level, and it broke the swing low support, thus becoming a pullback resistance. So as I mentioned earlier, pullback because we're expecting price to retrace back to that level. So you can see, ultimately, this is exactly what happened after that. It retraced back to this level, and once it actually reaches this level and reverses off of it, then it becomes an overlap resistance, but we'll get into that next. So this is the before. It's a pullback resistance because we're expecting price to retrace back to this level, and here's exactly what we expected. Okay, so as I mentioned, we're gonna see what happens once price reverses off of this level. It becomes an overlap resistance level. So before it touches this level, it is pullback. Once it touches it, it's an overlap. Okay, so we're gonna explain it a little bit more over here. Okay, so an overlap resistance occurs when price reacts off a particular level from the top and from the bottom. So the more times that it reacts off this area, the stronger the overlap area. So this means that there are more bulls and bears respecting that area. So it's an important area to take note of. So pro tip, if the overlap area lines up with other elements, such as Fibonacci or other graphical elements, then it makes it even stronger. Okay. So you can see from this GIF here, once price breaks out of this swing low support, as we mentioned, it's a pullback resistance. But since price reacts off of that level as well, then it becomes an overlap. So pretty straightforward for overlap, I think. But here are a couple more examples before we get into this week's content. So here we have a swing low support that becomes a pullback resistance once price breaks the support at 105.643. So here we can see how price reacted or retraced back to this resistance level and in fact reversed off of it, making it now an overlap resistance. Okay, so basically, when a swing low and a swing high line up in the same level, it's just an overlap level. And before the point when it forms a swing high, then it's a pullback. Okay, let's carry on. So here we have a combination of the pullback and overlap. So firstly, we have a big swing high resistance level, as you can see first over here. The moment price surpasses the swing high resistance, over here, it becomes a pullback support. And you can follow the green arrows over here now. So once price has made a pullback or retracement to our pullback support level and it bounces off of it perfectly, then it becomes an overlap support instead. Okay, another example. So we have two swing high resistances here, right? And then price breaks out of this swing high resistance, making it a pullback support. And the price has pulled back or retraced back to this support level and has bounced off of it twice. So it's a really strong overlap support level. Okay, this is our last example before we get into this week's content. So once again, we're looking at a combination of the pullback and the overlap. So we have multiple swing lows here. It's a swing low support, and then once price breaks the support level, it becomes a pullback resistance. And you can see, since we expected it to pull back or retrace back to that level, it did, and it in fact reversed off of it 3 times. Okay, so at this point, even at the very first point where it reverses off the level, it becomes an overlap resistance. And the overlap resistance becomes a pullback support when price breaks out of the resistance level, and it goes back to being a pullback. And then at this circle, the very last circle here, once price bounces off the level, then it is once again an overlap support. Okay, I hope that was clear. If we have time at the end, we'll look at a couple of charts together and see how we can combine what we've learned last week with what we're going to get into for this week. Okay, so let's get started with this week's content. So we're going to start off with drawing trend lines. So this is how you can draw a valid ascending trend line. Ascending trend lines should be from the bottom and not the top. So trend lines should have at least 3 significant touches. In this example here, I have 4, but 3 is enough. And 2 touches, the reason why we go for 3 is because 2 touches tend to be more coincidental. So we stick to 3. Okay, so here is another example. We have 3 touches on this ascending trend line. And here as well. Okay, pretty straightforward. So I'm just gonna get into the descending trend lines as well. So similarly for descending trend lines, they should be from the top and not the bottom. And trend lines should have at least 3 significant touches. Yeah, same reason, because 2 touches tend to be more coincidental. So here's an example of a descending trend line. In this case, we have 4 touches, but as I mentioned earlier, just 3 is enough. Here's another example. Okay, so take note of how significant or how clear these structures should be, these swing highs. Okay, and then in this example, which is the aftermath of this chart, so when you're looking out for a breakout, for example, we're looking at least 3 significant touches for it to be considered a valid trend line. But you can see over here that price is playing the reaction off of the 4th touch. So it's breaking out of this descending trend line. Okay. Okay, can you guys let me know in the chat if you think this trend line is valid? I mean, we can all agree it's a descending trend line, but let me know in the chat if you think this is valid or invalid. Okay, so this is actually invalid because, as we mentioned earlier, for a descending trend line, it has to touch the top and not the bottom. So the bottom is for ascending trend lines. So this is invalid. Okay, so next let's get into drawing trend channels. So channels require at least 4 significant touches, 2 at the top and 2 at the bottom, for it to be considered a valid channel. So they do not need to be in consecutive order like the picture on the right. So we'll look at a couple of examples. Here we have a descending trend channel, and you can see how clear the structures are here as well. Okay, pretty straightforward for that. Okay, let's just get into our next section, which is liquidity traps. So what are liquidity traps? So it's a situation in which monetary policy becomes ineffective in stimulating an economy, even when interest rates are near or at zero. So this occurs when because people and businesses are hesitant to spend their money, even at low borrowing costs, leading to a lack of demand for goods and services. In the context of trading, a liquidity trap can cause problems for market participants as as it may lead to a decrease in market liquidity, making it more difficult for traders to enter or exit positions quickly and at desired prices. This can result in wider bid-ask spreads, increased volatility, and decreased market efficiency. So central banks can try to address a liquidity trap by using unconventional monetary policies, such as quantitative easing, to inject more money into the economy and encourage spending. However, the impact of these policies on financial markets can be difficult to predict and may lead to unintended consequences. Okay, so I've included a graph over here just if you are interested in the economics of it all. But here's an example of how it will play out. Excuse me. Okay, so here we have a nice swing high reversal, and price surpasses the swing high resistance to clear the orders and then drops below the resistance level again. Okay, so in this case, you can see that we mentioned earlier this is a swing high resistance, and price has passed this level, making it a pullback support level. But instead of price retracing it and bouncing off of the level, it breaks out of the level again and drops below the resistance level again. Okay, so here's another example. Here we see price moving within an ascending trend channel and also moving above the Ichimoku cloud. So this gives us a bullish bias. Now at the 1.04791 swing high resistance level, the price drops and reverses off of this level. Okay, yeah, so that's basically it for liquidity traps. Now we're going to see how we can combine all of what we've learned so far when it comes to our trading. Okay, so here's just a checklist of things for you to look out for. So you can find this checklist as well as other tutorials on the Forex Army website. Maybe I'll just show you guys. Okay. Yep. So when you search up the forexarmy.com, this is the website that it will bring you to. And there are a bunch of trading guides over here, free trials as well, and trading tools for you to take a look at. So if you're new to drawing Fibonacci's, you can go ahead and take a look over here. The clear market structures gives you a very in-depth tutorial on just the basics and fundamentals of Fibonacci. So there's different examples as well. You can zoom in. You can go ahead and read these at your own time. And some risk management strategies as well, where to place your stop loss, so on and so forth, and support and resistance, which is what we have gone through for the past 2 sessions. And yeah, so you can find that checklist that I showed over here on the Forex Army website as well. Okay, so this is just a good way for you to, if you're a beginner, or even if you're not, this is just a good way for you to see all the different signs and signals that you can use to combine multiple technical analysis methods so that your analysis is more accurate. Okay, so let's take a look at some examples to play the continuation first. So here's another guide or checklist for you to look out for. So firstly, we have, is price respecting Ichimoku? Is price respecting the trend line? Key horizontal support or resistance levels? Is it near any key Fibonacci levels? And where's the next key level it might go? And then we fine tune with Fibonacci levels. Okay. Okay, so here we have an ascending trend channel with 2 top touches and 2 bottom touches, so we know it's a valid trend channel. Let's see how price will move within this trend channel. So here we are expecting a continuation, and you can see that's exactly how it played out, with price reversing off of the edge or the bottom of the trend channel as well. Okay, so here is another trend channel. In this case, we're looking at a descending trend channel. And in the GIF, once again, you can see this is how we are expecting price to continue within the trend channel. If you're looking for bounce or reversal, what we mean by that is they'll bounce or reverse off of the edges of the trend channel. So this is how we know that price is likely to continue within this trend channel. So once we have that, it's really easy for us to identify a breakout, which is what we're going to be talking about next. Okay, so here is another guide for you to look out for when you are identifying a breakout. So the price crossed below the Ichimoku. Do we have the Ichimoku momentum on our side? The price break any trend line? The price break a recent horizontal level? And the price break a recent key Fibonacci level? In which case we would then check for Fibonacci retracements. And then lastly, where is the next key level it could break out to? In which case we will use horizontal levels such as our pullback and overlap support and resistance levels. And then we'll fine tune those levels with Fibonacci. Okay, so here we have price breaking the multiple swing high resistance area. So we're looking at the bottom level first over here. We have 2 swing highs here. Price is breaking out of this level. You can see at the 125.744 level. So it's typically more of a level I mentioned earlier, but in case you missed it, you don't have to stress too much about it being at a specific level, because more often than not, it's more of an area. So by combining these levels with Fibonacci levels, we can analyze where price could possibly hit next. So in this example, price has reached the 61.8% Fibonacci projection. So for Fibonacci projection, we want to look for kind of a flash kind of shape or lightning shape, if you can follow my mouse. Yeah, so we have the starting point, the middle point, and the ending point as the shape. And then for Fibonacci projection, we used the 61.8, 78.6, and the 100% level as well. But in this case, we are projecting the level we are projecting price to break out of the 61.8 and expect it to rise to the next swing high resistance, which is over here, and maybe even to the next Fibonacci level, which is the 78.6. Okay, so this is what has happened. Price has moved above the 61.8% Fibonacci projection level and has risen to the next swing high resistance over here. Okay, so that's how you play a breakout, just solely from looking at the horizontal levels. And also Fibonacci levels in this case. Okay, and another indicator of price, that price is likely to move upwards, is that price is moving above our Ichimoku indicator. So it's also giving us this bullish signal. So with all of that upward movement, we can expect that price is likely to continue to move upwards, which is exactly what it did. Okay, let me know if there are any questions. Okay, all good. Let's move on to our next example. So here we're looking at price continuing within the descending trend channel. So just a recap once again, 2 touches on top, 2 touches below. In this case, we have 3. Okay. And we want to take note that price has recently broken out of this ascending trend line over here. So price is breaking out of an ascending trend line. Firstly, number 1, price is breaking out of the ascending trend line. Secondly, it's continuing within the descending trend channel. And thirdly, it is also breaking out of the Ichimoku cloud, and it's moving below it instead of above it. So all of these signals give us a very bearish bias. Okay, now we take note of the next swing low support, the closest swing low support to where price is currently at. So that would be over here, but that's a bit too close to where price is at. So we're looking at the next level, which is the 1.03488 level. Okay, and we are projecting price to continue down to this level here. Okay, and you can see that's exactly what happened. Price broke out of the ascending trend line and continued downwards to our next swing low support. Okay. Okay, let's take a look at another example. So price recently broke out of our ascending trend channel here. You can see this red highlighted area here is when it broke out. So in this case, we are making use of a Fibonacci extension. So for Fibonacci extension, we are looking for the shape of a Nike tick, which is like this. So in this case, it's inverted. But if you take a look here, you can see where my Fibonacci starts is the head of the Nike tick, or just a tick in general. It's the head of the tick, and then the tail of the tick should retrace back more than 100% for you to use this this Fibonacci method. Okay, so once it retraced 100%, it broke out, and then that's when we can use this. So we took the starting point from here and the ending point here. And for Fibonacci extension, we use 2 levels, 127.2%, which you can see here, which is where price is currently at, and also the 161.8. And just nice, we can see the 161.8 lines up nicely with our 0.66420 swing low support. Okay, so in this case, once price breaks out of this 127.2, which you can see it did, then we are expecting it to continue to head towards this support level here. Okay, and that's exactly what happened here. You can take a look at this GIF. So you can see price did reverse off of the 127 just briefly, but then it shot back down to the 161.8 and our swing low support just as expected, and then it reversed off of it immediately. Okay, and then one of the reasons why it might shoot back upwards is because of this support level here. We have a swing low that is lying nicely with a 161.8. And in fact, now that I'm looking at it, it seems like we could have an overlap. Oops. I could have pulled this support level back over here as well. And you can see how many times price has tested the level. So you can tell that this level is pretty strong. And it also lies nicely with a Fibonacci extension level. So with all of that lined up together nicely, it's a Fibonacci confluence, which has a lot of resistance at that area. So price is likely to reverse off of it. Okay, let's move on to our next example here. So price recently broke out of this descending trend line. You can see our descending trend line here with multiple touches on the trend line, and then price broke out of it here. Okay. Once again, we are making use of Fibonacci extension. You can see the tick pretty clearly now. This is an upright tick, and price retraced it 100%, so we can use it. And where price is currently at now, it has already surpassed our 127.2% Fibonacci extension level. Okay, so now if we're taking a look at our buy entry, why is it that we placed it over here? It's because we have an overlap level here. We have two swing highs as well as one swing low here. So this is, and price has actually broken out of the buy entry. So instead of, or rather we can see that it's a pretty significant level. But I mentioned earlier that this is an overlap level, but since price has broken out of it once again, you guys know that this is a pullback level instead. Okay, but my point is just that this level is pretty significant and pretty important to take note of. Okay, so we are buying a take profit towards the next level at the 161.8, but we are putting it a little bit lower because if you saw in the risk management webinar, we would place our take profit below any major confluence areas or before, simply because there is a higher chance that we are going to, or that price is going to hit our take profit level. Because as I mentioned earlier, these Fibonacci confluence areas tend to have a lot of resistance in that area, making price reverse off of those areas. Reverse off of those areas. So in order to make sure that our price actually hits our take profit, we'll place it slightly lower than our Fibonacci levels. Okay, so, and we can also see that at this take profit level, the 85.724, we have a swing high resistance here. And if I can pull it back, I think we have an overlap level as well. Okay, so it's pretty significant, all of these areas, and you can see that's exactly what happened. It broke really nicely off of our take profit. and has in fact risen above the 161.8 level as well. Okay, that's our last example for this webinar, but I'm just going to pull out a couple of charts to show you guys how you can combine all of these levels for your trading strategies as well. Okay, let me just pull up my charts. Okay, let me see. Okay, yeah, you guys should be able to see my charts now. So I'm just gonna quickly go through maybe one chart just to show you guys how it works. Okay, let's take a look at excuse me. Let's take a look at USD JPY. Okay, so we will typically start on the higher time frames first, just so that we get an idea of where prices are headed towards. Okay, so this is our weekly time frame, and you can see prices look like it recently reversed over the swing high, but it's generally moving upwards. Okay, next, our daily time frame. Okay, looks like it's dropping as well. General trend upwards as well. Okay, 4 hours. Okay, on our 4 hours chart, it looks pretty upward as well. Or trend channels. So in this case, I have a ascending trend line with 3 swing lows here. Okay, next, after we've done that, then we'll go in with our support and resistance levels. So your first support, or rather your first resistance, will be at the closest swing high to where price is currently at. So that's over here. So this is just purely based on graphical analysis, but we'll go in and tweak it with Fibonacci levels in a little bit. Okay, so here is my swing low support. Okay, so maybe we'll just briefly go through this second resistance. Okay, so the second support level over here is an overlap support. You can see we have 2 swing highs and 1 swing low here. So it's an overlap support, and for our first resistance, we have 2 swing lows lining up. So these levels are pretty significant. Okay, so now let's go in with our Fibonacci levels. So I'm gonna firstly be looking for a retracement. So for Fibonacci retracement, we use these 5 levels: 23.6, 38.2, 50%, 61.8, and 78.6. Okay, so I can see that my 38.2 lines up with my first support, and my 50% also lines up with my second support. So I'm just going to keep those two so it's not too messy. Okay, and then I'm going to be looking for a projection. So as I mentioned earlier, projections, we use these three levels. Okay, and I see my 78.6 lines up nicely with my first support and my 100% as well. So I just want to highlight this flash shape here that I'm looking at for our Fibonacci projection. Okay. Okay, all good so far. So we can expect price to continue moving downwards from our first resistance all the way towards our ascending trend line. Okay, and it's likely to reverse off of this trend line as well. Why? And how do we know it's gonna continue within the ascending trend line? Because we have these two Fibonacci retracements and projections lining up nicely. And we also have these two swing lows here. Okay, so I wanted to move it over here to show you guys that this is an overlap level, but I'm not going to because if I zoom in here, you can see that I'm cutting too many bodies of candlesticks. So I'm just going to keep it over here with the two swing lows. Okay. Okay, now that we've done that, then we'll go in with a couple of indicators to support our analysis. Okay, Ichimoku. Okay, Ichimoku is giving us bearish. MACD is also giving us bearish. Okay, RSI is also giving us bearish. Okay, so we can definitely expect price to continue downwards towards our first support. As to whether it will break out, as I mentioned, it probably won't. Yeah, because of the huge confluence area over there. So there's a high chance that will probably reverse off of the first support or this ascending trend line. Okay, maybe just another thing to note for you guys before you guys go. We have so this is where our descending trend line on our RSI starts, whereas on our price chart, this is where our price starts to head downwards. So you can see on our RSI, it's kind of a predictor to show you where prices are headed towards. And this is what we call a bearish divergence. So we can expect price to continue to move downwards because of all the downward pressure. Okay, that's all I have for you guys today. Let me know if there are any other questions that you guys have. I'm happy to stay for a few more minutes if you guys have any questions. If not, you guys can leave. Thank you guys so much for joining me today and have a great rest of your week. Bye, guys. Fundamentals is super important. So we will look at okay, let me show you. So we use Forex Factory to look at all of the important announcements for the week. So you can see here. So I will normally only look at the red calendar events. But I know a lot of people prefer to look at these as well. So we'll look at, okay, if you're talking about Japan, yeah, we will follow these as well, like all of the forecasted previous results as well. Yeah, not just technical analysis. Yeah, for sure. If you are trading Forex, it's super important for you to take note of any announcements as well, because it really affects. Okay, no problem. So let me know if there are any other questions. If not, you can feel free to leave. Okay, if technicals and fundamentals are giving you opposite signals, it really depends on the context of it. Yeah, because even using technicals, sometimes, for example, if I'm using an indicator, there are so many indicators, 50% of them will give you a bullish signal, 50% will give you a bearish signal. So I tend to listen to the fundamentals more. Yeah. Yep. If you're talking about short-term trading, like if you are scalping, then that definitely could be one way to do it. Because in these webinars, we're typically not looking at short-term trading. We like to look, since we're trading on either the 4 or 1 hour, we're looking at a longer time frame. That's why we don't really take into account the candlestick shapes. Yeah, because those tend to fluctuate on a longer time frame. Yep, for shorter time frames, that definitely will make sense. No worries. Thank you guys so much for joining me today. Hope you guys found it helpful. Okay, see you guys next week. Bye.